Investor, you could use this to acquire assets. A HELOC, you do not lose access to that liquidity. So the HELOC is what we call simple interest. And there is a difference, which is kind of subtle. And they just think, wow, I just got $200,000 of free money. What? Banking allows you to become your own banker. There's no credit check. There's no bank involved. It's a contractually guaranteed right.
Hi, everyone. This is Jack Allwell with another money episode. This is the second segment of our discussion with Logan Hertz. Now we're going to be discussing the velocity banking process through the first lien HELOC. Logan, it's good to see you again and excited to extend this conversation.
Absolutely. I will, first of all, caveat that I'm not necessarily the foremost expert in velocity banking. I consider myself an expert in infinite banking. That's really what I do. Velocity banking is a great complementary strategy, and I know enough to be dangerous on it, but I'm not necessarily the world's foremost expert on it. But enough down an introductory conversation.
Okay. Well, let's start out with something people might be a little bit more familiar, just the basic HELOC. Can you describe what a HELOC is and how people use it?
Yeah, it's a great question. A HELOC is a home equity line of credit. It's basically a line of credit against the value of your house. So if you have equity available to you in your house, you can take out a line of credit against that equity. Typically, they'll give you up to 90% of the value of your house minus whatever you still owe on the mortgage, okay? And then the important thing about a line of credit, as opposed to like a loan or a mortgage against your property, is that it's a two-way street. It operates like a credit card that's backed by your house. So you can pull money out of it, and then you can pay money back into it. So when you pay down or pay off a HELOC, you do not lose access to that liquidity. So if you have a $100,000 HELOC, and let's say you pull the full amount, and then you pay it off, you now have access to $100,000 again, right? So it's a two-way street, which is really important for some of the strategies we're going to be discussing. You can get access to the equity in your home through other methods, like a cash out refinance or a loan, a home equity loan, but that's a one-way street. You get a lump of cash in your pocket, and then you make payments back according to some set schedule. But when you make a payment back, you cannot pull that money out again. It's a one-way street.
Okay. And when people typically discuss HELOC, they're talking about a second position HELOC on top of their primary mortgage. Now, I guess the question is, if you have the primary mortgage and the HELOC, if you then pay off the primary, do you all of a sudden have a first lien HELOC?
Yeah, you kind of do. So it's a good question. So you're right. So the typical HELOC is what we would call a second position HELOC, typically. So you'll have your mortgage. Let's say you owe $300,000 on the mortgage. Your home is worth $600,000. You could, as an example, take out a $100,000 HELOC, which would be in second position. So it's on top of your mortgage. So your mortgage is in first position, and then your HELOC is in second position. That's what's typically done. And typically, a person might use a HELOC to do, for some short-term financing, maybe they're adding a deck to their house, maybe they're remodeling their kitchen or something like that. They're using it to remodel their kitchen, right? You can use them that way. With some of the strategies we'll be talking about, they're going to be more advanced use cases. Typically, it's going to be accelerating your debt payoff in a very creative way, which just takes advantage of the structure of the HELOC, or it might be for investing, right? So real estate investors love HELOCs. They use them all the time, okay? But typically people, when they're talking about HELOCs, they're typically talking about a second position HELOC, not a first lien HELOC. There is a difference. And you made an important point, because when I say first lien HELOC, okay, let's say you had a paid off house. You could go to the bank and get a HELOC against your house, and that would technically be a first lien HELOC because the bank is in first position. But when we use this phrase, we're usually referring to a much more advanced product that has the whole velocity banking strategy associated with it. So it's not just the fact that it's a first lien HELOC, it's also some other things we'll be talking about in terms of how you're using it, right? So the sort of first lien HELOC strategy we're talking about will work very differently from your standard HELOC, where you're just using it for some short-term financing.
I mean, can you go over some of those broad differences?
Sure. So in general, so there's the first lien HELOC, and then there's velocity banking. Velocity banking is the strategy the first lien HELOC is one of the vehicles you can use. It needs to be a line of credit. Typically, a HELOC works best, but you could use a second position HELOC to do velocity banking. And basically what you're doing is you're running your cash flow, you're running your income through your HELOC rather than through a standard checking account, right? And that gives you a lot of benefits where you're getting basically a more efficient cash flow management tool. With a first lien HELOC, what it does is it actually automates the velocity banking program. So let's say you have a $300,000 mortgage on a $600,000 house, okay? You can replace your mortgage with a first lien HELOC. So your $300,000 mortgage goes away, and now you have, let's say, a $500,000 HELOC, a $500,000 line of credit with a starting $300,000 balance. Okay, so your balance hasn't changed, but it's moved from a mortgage to a HELOC. So one advantage you can see right away is you immediately freed up $200,000 of equity in your house that you could use if you wanted to, right? And there are various ways you could do that. More importantly, what we have with this product is it automates the velocity banking process. So in addition to the first lien HELOC, you are given a checking account, which is automatically linked to your first lien HELOC. So you move everything over to this new checking account, your income comes into your checking account, and then without you doing anything, it automatically gets applied to your HELOC balance. And then same thing when you spend money, it gets automatically pulled from your HELOC balance. So without you changing anything, all you're doing is replacing your Wells Fargo checking account that you're using today with this new checking account that you're using tomorrow. And you're not changing anything you're doing, but behind the scenes, you're using the equity in your house and it's getting paid down a lot faster without you doing anything, right? And you have access to all the equity in your house. So unlike a mortgage where it's a one-way street where when you pay down the house, you don't have access to that money. Since it's a two-way street, it's a HELOC. When you pay down your house, you free up that equity and you can use it if you want to, okay? So let's say you have a $10,000 paycheck come in, your $300,000 balance immediately goes down to $290, all right? Then let's say at the end of the month, you have $5,000 worth of expenses. Your $5,000 worth of expenses comes out of your HELOC. Now your balance goes back up to $295. So on net, your balance just dropped by $5,000 without you doing anything, just by running your income through that HELOC, right? There's a whole host of other advantages that I'm kind of skipping over. One thing is now all of your income is working for you all the time. So it's true that your balance went down on net by $5,000, but the full $10,000 hit your HELOC and paid it down at least for some period of time, which will reduce your interest costs. Because interest for a HELOC is calculated based on the average daily principal balance. And so if you reduce the principal balance even for just a few days, that brings down the average on which the interest will be calculated. So even the money you're spending is now working for you. So that $5,000 that you spent, it probably sat in your HELOC for 2 weeks, which brought down the average daily principal balance. So even the money you're spending is now helping you pay down the house faster, reduce your interest costs. Okay. Additionally, what you can do now is you can refinance some of your other debts into the HELOC, right? So let's say you owe $10,000 on a credit card and it's a really high interest rate debt that's eating you up. You can now pay it off from your checking account, which is effectively pulling $10,000 from your HELOC to pay off that credit card, right? Maybe your credit card is charging you 20%, 18% interest, right? The HELOC might be charging you 7% or 8% interest, right? You just refinance that into a more efficient form of debt. And another really important thing is the cash flow. So when you have a mortgage, you have a set monthly bill, which for most people is their largest monthly expense, right? Let's say it's $3,000, right? Every month you have a $3,000 payment that goes to your mortgage, right? Probably the majority of it is going to interest, not even the principal, right? Depending on where you are in your mortgage, depending on how new it is, okay? Because it's amortized, and that's a whole nother conversation. But now you just eliminated that. Because with a home equity line of credit, you have no set monthly payment, right? It's interest only, and that interest payment is made automatically out of the equity of your house at the end of the month. So you don't consciously make any payments, right? So from a cash flow perspective, what we just did is we just eliminated your largest monthly expense. And all of your free cash flow now is being applied to your home equity. Let me stop there. I know I said a lot.
Yeah.
We got a ton of questions.
So I think the interest calculation component is honestly probably the biggest, or in my eyes, like something that people don't really maybe appreciate. So in your example, they started out with a 300 balance, paid off 10, let's say half the way through the month, then they had those expenses, goes back up to 295. So like, I guess the average daily balance is like 292.5. And then,
Yeah, something like that. Right.
and then
Then it would be, yeah,
and then we're saying the interest gets applied to that number.
correct.
Okay.
So you will be paying, even though 295 is your ending balance that month, you will be paying interest on less than 295 because the average daily principal balance will be less because your income sat in the HELOC for some period of time, right?
To your point that you brought up in the beginning of the person that has like a $300,000 primary loan, and so you can just refi into a HELOC.
Yes, you can even buy a property with a first lien HELOC. You can go buy, as an example, a primary residence, put 10% down, and finance the remaining 90% with a first lien HELOC. You can also refinance your existing mortgage into a first lien HELOC. You can do it it's typically on a primary residence, but you can also do it on a second home. You can do it on an investment property as well.
Can you talk about the structure of the terms of the HELOC in terms of, I'm guessing the rate's going to be a little higher?
The rate is higher, yeah. So let's jump into that because this is the biggest objection. So when you replace your mortgage with a first lien HELOC, the interest rate will usually be higher. Not always, but usually it will be higher. And that's the biggest objection, right? So let's say my mortgage was going to charge me 6%, but my first lien HELOC is charging me 8%. Why would I exchange a 6% loan for an 8% loan, right? Well, we have to dig a little deeper than that, right? We have to, it's not just about the numbers. There's the fact that the mortgage interest is actually what we call amortized interest, whereas the HELOC is what we call simple interest. And there is a difference, which is kind of subtle. It's not obvious, but the first question I would ask people is, okay, you're paying 6% interest. Look at your mortgage payment and tell me what percentage of your payment is going to interest versus principal. A lot more than 6% of your payment is going to interest, right? That's because of the amortization schedule, which means that the interest payments are kind of front loaded, right? So in the early years, you're paying a lot, you're paying mostly interest. You're not really moving the needle on the principal balance as well, right? Whereas with the HELOC, yes, your interest rate will be higher, but you're going to be paying down that principal balance so much faster because 100% of your income that hits that HELOC is going to principal. All of it, right? So imagine how fast your mortgage balance would disappear if 100% of your payments were into principal. Now, there is an interest payment that's made on the HELOC. The other thing that it does too is it enables you to safely pay a lot more towards your house, right? So the problem with a mortgage is that it's a one-way street. So let's imagine a scenario where I have that same $300,000 mortgage, and let's say I have $300,000 in cash, but that's all the cash that I have. That's everything I have, right? Well, it would probably not be a good idea to take that full $300,000 and just pay off the mortgage, right? Now you'd have a paid off mortgage, that's true, but you'd have no savings, no liquidity, nothing to fall back on if there's any sort of problem, nothing to use for opportunities if some great investment comes up, right? So the problem with a mortgage is you now it's an either or scenario. Either you can pay off the mortgage or you can have the liquidity, but not both. So if you make extra payments to your mortgage, that's money you don't get back. That money's now gone. It went to the bank, you don't get it back, right? With the first lien HELOC, you do get that money back. Now it's a both and scenario. So let's imagine I replace my $300,000 mortgage with a $300,000 first lien HELOC. Now I can safely take that $300,000 I have in savings and totally pay off the HELOC. And guess what? I didn't lose access to $300,000. Because it's a two-way street, I still have access to that full $300,000 and I can pull it out anytime I want. So the other thing the first lien HELOC allows you to do is to move your savings from a savings account into your house, right? Where now your liquidity, your safe pool of liquidity, whether it be your emergency fund, whether it be for opportunity, if you're a real estate investor or just an average Joe looking for opportunities, right? You can now have both, right? You have a paid off house, so you're no longer paying those interest payments, but you still have the liquidity too that you can use. And that it is earning interest, so to speak, in a sense that the value of your house is going up, hopefully, right? So whatever rate the value of your house is going up, that's effectively the rate that your savings is now earning, which is probably at least competitive with what you're earning in the savings account, probably more, right?
Now, the HELOC itself is not actually, there's no sort of, I guess, mapping of the market value with the available liquidity, correct? Like this wouldn't adjust with the market.
Correct. You're right. So it would be, you're right. The appreciation of the value of the home doesn't automatically mean your HELOC amount is increased. That's true. You would have to periodically refi it to get access to the additional value of your home. Don't quote me on that, because I think there might be some products either already available or kind of in the market where that's kind of baked in, where there's a raising amount. I do know that they make it very inexpensive and very easy to, if all you want to do is refi because the value of my house went up, they waive a lot of the fees. So like as an example, one of the lenders I work with, they charge an origination fee the first time you do the HELOC. But then if you're just refining that HELOC, they don't charge that fee anymore, right? So that people will typically do that. They'll do it for a couple of reasons. First of all, obviously, yeah, if it's 3-5 years later and your home went up in value, you want to refi to get access to that additional equity. Also, it keeps you in the draw period. So now again, this depends on the lender. So one of the lenders has a 30-year draw period actually, but typically it's a 10-year draw period followed by a 20-year amortized repayment period, because this is, after all, a HELOC under it all, right? And so by refinancing strategically every 5 years or so, you always keep yourself in that draw period, which is where you want to be, right? That's where it's a two-way street, right?
So for people that I actually might need some clarification. So when you say draw period, that's what you're referring to is the two-way. I can put in and take out, but after the draw period, you cannot.
After the draw period, if you have any balance left, it becomes just like a mortgage.
I see.
It converts to a 20-year amortized mortgage is what it does.
Interesting.
Now, there is a lender that has a 30-year draw period on a first lien HELOC with a catch. What happens is after the first 10 years, the amount you can draw starts going down. And over the next 20 years, it goes down until eventually it hits zero. Right? So you have a 30-year draw period, but you only get the full 80% or 90%, whatever loan to value they're giving you for the first 10 years, and then it starts reducing.
Yeah, I guess that kind of makes sense from the lender side, because they don't want all that exposure of people keep wanting their money in and out. And
Yeah. Let's talk about that. So these products are sold very differently from your standard HELOC. So these banks want you to work through an ambassador like myself. So I'm an ambassador for these programs. They have official ambassador programs. They don't like people coming in off the street and saying, I want a first lien HELOC, because they have to vet you, not just from like a credit score perspective and income and all that stuff. They need to make sure you understand this specific strategy. Because if you took out a first lien HELOC and you tried to use it like a standard HELOC, it'd be a disaster. Because the whole point of this is you need to be applying the velocity banking strategy where you're running your income through the HELOC, right? Otherwise, you're not going to pay down the balance fast enough, and it's going to work against you. That higher interest rate will work against you if you're not using it properly, right? So the bank wants to make sure that you're working with a financial professional like myself who can help coach you on the process so that you use it responsibly. Because some people who have good credit scores might look at that example where they have a $300,000 mortgage and they replace it with a first lien HELOC and they just think, wow, I just got $200,000 of free money. Woo! Right? And then they go and spend it on whatever. Well, that would be a disaster, both for the lender and for the bank. So they need to understand the strategy we're using. So yes, this is just like any other tool. It has to be used properly or else it can work against you. So there are definitely people who would not be good candidates for velocity banking, either because their cash flow situation isn't right yet, or they're not responsible enough, or they don't understand the velocity banking strategy, right? So this is definitely not for everybody. Now, the most typical use case you'll see is debt payoff. So if you have a lot of debts, whether because you're a business owner or maybe you just have, even if a responsible person might have student loans, car loans, right? Credit cards, they might have various debts. And by refinancing those debts into the HELOC and then running your cash flow through your HELOC, you get a much more efficient debt payoff schedule, right? And you can see this, and there are people who run lots of scenarios with numbers showing you how you can pretty dramatically accelerate your debt payoff by applying this strategy. That's the most typical strategy. And then the question becomes, well, once I've paid off all my debts, then what, right? And then for me, you keep applying the same strategy, but now instead of paying off debts, you're acquiring assets. It's the flip side of it. It's the exact same strategy, but it's the flip side. So on the front end, as you have debts, you use this strategy to pay off those debts in the most strategic manner, and you're paying off the debts a lot faster and you're paying much less in interest, right? The flip side of that is instead of reducing your interest costs on debt, increase the interest you're earning, right? By using the equity in your home strategically to acquire assets. So you're a real estate investor, you could use this to acquire assets, right? And people who are in real estate understand the importance of having access to liquidity, right? There are deals out there, but how quickly you can get access to liquidity might determine whether you get that deal or not and what price you're going to pay on it, right? So if you have $400,000 of liquidity sitting in your primary residence, your first lien HELOC, that's just as good as cash, and you can come to the table with $400,000 of cash, you have a lot of buying power, and you can jump on deals, right? Because there's no financing contingency. I don't need to get a mortgage, right? I can just buy it and be done. Close in a weekend, right?
Mhm.
And from your perspective, the beautiful thing is, it's the same as cash to the seller, but you actually financed it, right? You financed it using your first lien HELOC. And now you're going to apply the velocity banking strategy to pay down that HELOC and then rinse and repeat. You'll now strategically pay down that HELOC until you freed up enough equity and you find the right deal, and then you go and strategically deploy it again. And the assets you're buying, the cash flow from those assets also gets cycled back into the HELOC. So you create this virtuous cycle of strategically financing an asset from your HELOC, then using the cash flow from that asset to help pay down the HELOC in addition to your normal income, and then rinsing and repeating, right? So I guess I'll also add too, another thing people should be doing is buying whole life insurance policies. You should be using your first lien HELOC because you're using it to buy everything, right? You're using it for everything to buy whole life policies, and you can do the same thing there if you want to. Once you buy that whole life insurance policy, you can take out a policy loan and pay down the HELOC, right?
Yeah, so I guess the doomsday scenarios for using a tool like this, like you said, you take the $200,000 extra of liquidity just to have fun. Basically, it's not that money's not returning you any type of capital. Also, people I guess that aren't really cash flowing that high, they'd be better off just going the normal traditional mortgage.
Correct. Yeah. So let's talk through some of the drawbacks. So obviously, the interest rate is higher. That is a drawback. I will certainly acknowledge that the interest rate is higher. With velocity banking, what we would say is what matters is not the interest rate, but how much interest you actually end up paying, right? This strategy enables you to pay down the principal a lot faster. So effectively, you pay a lot less in interest. But if you're not paying down the principal faster, it works against you. So the fact that it is, I say typically, it depends when you got the mortgage and when you got the HELOC. There are some people now who are taking out HELOCs that have a lower interest rate than their mortgage. So that can happen, right? Depending on when you took out the mortgage and when you're applying for the HELOC, that can happen. Also, depending on what your credit score was when you took out the mortgage, right? Things like that, right? So the interest rate is higher. Your cash flow needs to be strong enough to compensate for that, right? So the stronger your positive cash flow is, the better this will work for you. The more you don't have positive cash flow, or you're breaking even, or you have negative cash flow, the more this will not work for you. It will work against you, right? Because then you have no extra money to apply to the account, so to speak, right? You need to be financially responsible. This strategy requires you paying down your house, meaning you can resist the temptation to just pull that equity and go buy stuff, right? It's not free money. It's money with a cost associated with it. And if that cost is justified, like if I'm paying off other worse debts, or if I'm strategically purchasing assets, then it totally makes sense, right? The other thing is you're working with a bank. So I love both velocity banking and infinite banking, but in my opinion, infinite banking is more foundational, because infinite banking allows you to become your own banker. When you take out a policy loan from your whole life insurance policy, or against your whole life insurance policy from the insurance company, there's no credit check, there's no bank involved, it's a contractually guaranteed right. So you have complete and total control over when you take out a policy loan, for how much, and when you pay it back. It's totally up to you, right? You could never pay it back. It's up to you, right? When we're doing velocity banking, it is analogous to infinite banking in that we're running our cash flow through an appreciating asset and then borrowing against that asset, okay? The difference is we now are working with a bank. So there's no contractually guaranteed right that you can get a HELOC against your house. You have to qualify, right? You have to go through the credit check and all of that. And the bank will tell you what the terms are based on current interest rates, based on how much equity is in your house, based on your credit score, based on your income, things like that, right? So the bank does have some degree of control. So the doomsday scenario would be the bank freezes your HELOC, which is hypothetically possible, right? So the bank could freeze your HELOC. There would be reasons they would do that. And my counter to that argument would be like, okay, let's think through that. Why would the bank freeze your HELOC? And let's think through how and why that would happen. And in my opinion, what you'll find is when your bank freezes your HELOC, the problem is not velocity banking. There's some other problem that was going to blow you up anyway, right? So and this gets to the advantage of a first lien HELOC over a second position HELOC. So during the 2008 financial crisis, when houses were crashing in value, second position HELOCs, a lot of them got frozen. First position HELOCs did not. So I had an interview with Andy Brown, who does the all-in-one loan, which is a first position HELOC. He had an all-in-one loan through the 2008 financial crash. None of their lines were frozen, nor were they even reduced. And his all-in-one loan helped save him during that time because he's in the mortgage business. The mortgage business got crushed in the 2008 financial crash. He suffered a severe, reduction in his income. And the all-in-one loan that he had gave him extra liquidity that he could use from his house that helped him weather that storm and get through that crisis. Mm-hmm. So it really saved him financially. So historically, first lien HELOCs have not been frozen or even reduced during the worst housing crisis on record, right? So, but it is possible. An example would be if you declare bankruptcy, the bank would be required to freeze your HELOC. They would be legally required to do that, right? So when we think through the various scenarios of why would the bank freeze your HELOC, right? What you find is it actually still puts you in a better position. What you find is the problem wasn't your HELOC or velocity banking. The problem was something else that then led to your HELOC being frozen. I had an interesting comment on one of my videos where this guy was like really scared and he's like, man, this is really scary. Like the bank could freeze your HELOC and then that means you have a required payment coming in, but that you can't pull anything out. And I said, Well, that's exactly the same as a mortgage. When you have a mortgage, you have a required payment coming in every month, and then you cannot pull anything out. That's exactly how a mortgage works. So what you're saying is, in the absolute worst case disaster scenario, the bank freezes your HELOC, you have required payment coming in, but you can't pull anything out. So in other words, the HELOC works the same as a mortgage as far as that goes. It's now a one-way street, not a two-way street, right? Now, of course, obviously, though, in fairness, that is a negative. The negative is the bank has some degree of control over that line of credit. You had to qualify for it. They're the ones extending it to you. They're the ones setting the terms. And so the bank definitely has some degree of control over it.
I mean, on the underwriting point, I mean, you said these banks like going through ambassadors like yourself. How are the underwriting requirements compared to just like a normal mortgage? Is there a lot of more bells and whistles they want you to go through? And like, what are the closing costs similar to like normal closing costs for a primary residence?
Yeah, these are all good questions. Now, I'll just say I'm not a mortgage loan officer, I'm an expert in that. But in general, I would say the underwriting is a little more difficult than a mortgage. So it's roughly the same process and it's roughly the same criteria in terms of underwriting, but it is a little more difficult. So yeah, if you can, some people will have more challenges qualifying for a first lien HELOC than a mortgage, because in my opinion, it's a better product and it requires more financial discipline and education on the part of the borrower. So yeah, underwriting is a little bit more strict with a first lien HELOC than with a mortgage. The closing costs, I think, would be a little bit less than a mortgage, but you'd have to ask and go through that. Of course, all that varies, depends on your state, depends on your situation. But HELOCs typically are going to be less expensive than a mortgage as far as closing costs. Now, a first lien HELOC, I think, as far as closing costs, would be more expensive than a second position HELOC, but less because they're replacing a mortgage or you're buying a house, right? But probably a little bit less expensive than a mortgage. But again, this is where I'm not a loan officer, so I don't get too deep into all of those details. I do have information on that, but I don't want to share it because it was like a year ago and it's probably out of date, right? And then when you throw out a number, everyone concludes that is the number, right? And it's like, yeah, all this kind of changes as the market changes. But yeah, I would say the process is similar to taking out a mortgage, right? It's a similar process. Underwriting is a little bit stricter.
Okay. And then I did have one like oddball question. Like if someone came to you, I know in like the Bitcoin space, a lot of people are starting to talk about this in terms of borrowing from other assets just to put into Bitcoin because they believe it is like a better long-term store of value. So if someone came to you like with this, like, I guess, hypothesis, what would you kind of walk them through? Like maybe just a regular mortgage would be better for them? Or what would you think about just kind of almost like speculating using the money and something that's not producing cash, but they just think is a better store of value?
Yeah, I don't give investment advice. In general, I would not recommend using leverage to speculate if you're going to buy speculative assets. I think something like this, again, we're talking about cash flow. Now, what I would say is this: your first lien HELOC is going to replace your checking account. So if you're planning to buy a speculative asset anyway, assuming your position size is reasonable, then I would say go ahead and do it. That's what you're going to do anyway. Now you're just doing it you're doing it with a checking account, right? Because everything's going through there. And because you're position sizing appropriately, it's going to be an amount that you could have paid with cash. Like before, when you had the mortgage, you could have bought it with cash. Now you're buying it with your first lien HELOC because all of your income is flowing through your HELOC. So I don't view it the same way as saying, oh, I'm going to go take on debt, get money that I don't have, right? And go buy a speculative asset that doesn't cash flow, right? And that to me is the key distinction. I'm not saying Bitcoin is a bad asset. I'm not saying it won't go up in value. I'm not saying it won't go up tremendously in value. I'm not saying it's not a good long-term store of capital, but it doesn't necessarily provide cash flow to pay back those debts, right? So typically, if people like real estate investors are using HELOCs, some of them do believe in cryptocurrencies and they own cryptocurrencies. But typically when they're drawing large amounts from their HELOC, they're using it to buy real estate because that cash flows, right? Either something that cash flows or something that's more short term, where you're going to be realizing a gain and then you can use that to pay off the debt. But I don't give investment advice. My short answer to everyone is always, look, I can talk you through how I would think about it and my philosophy, but at the end of the day, it's your decision. It's your money. It's your decision. I don't tell people what to do with their money, but I just kind of help them tell them how I think about it and help them have the right philosophical framework.
Yeah. I mean, what's like a question you think I should have asked you about first lien HELOCs, or what would you like the listeners to know that maybe we haven't talked about yet?
I think when you look at it, a lot of people talk about velocity banking like it's just debt payoff, like that's all it is. It's actually more than that. It is a more efficient cash flow management strategy. So, because a lot of people, myself included, when I first started looking at it, I was like, oh, this is cool, but I don't have any debt, so I don't care, right? And come to realize that, again, you can use velocity banking to pay off debts. That is sort of the no-brainer strategy because you already have these debts. You already are beholden to these lenders. You might as well pay it off in the most efficient manner, right? No-brainer, okay? But then the flip side of that is once you pay off those debts, or you've paid off the toxic debts, or you've paid down debt enough that you're comfortable, now the flip side of that is now let's go buy some assets, right? And even if you don't use the money, just having access to the equity in your property, I think is a good thing for anyone, even if you never use it. So if you're the sort of person who hates debt and you just want to be debt free, I think being debt free with a first lien HELOC puts you in a better position because you eliminated your housing debt and all your other debts, but you still have access to all that money you used to pay off the debt, right?
I guess one thing you just said triggered. Are you allowed to get a first lien HELOC on an investment property?
Yes, you can. Yes, you can. Not all lenders will do it, but there are some who will. Now, believe it or not, the investors who use first lien HELOCs, they typically start with their primary residence because you're going to get better terms there. And it's cash one way or another. Where you get the cash from is not as important. So they'll typically start with their primary residence. And what they'll do is, then what you can do is you can have the first lien HELOC on your primary residence. Use that first lien HELOC to come up with a down payment to then buy your investment property with another first lien HELOC, right? Now, it depends what you're buying, right? Obviously, not all rental properties, there are going to be limitations. You're going to have to work with a bank, and obviously a bank isn't going to finance anything. But you can do rental properties.
For that. Well, Logan, it's been fun discussing this. Why don't you tell the listeners once again where they can go learn more about you or get in touch with you?
Yeah, youtube.com/@Hazeltine LLC. We're also on LinkedIn, Hazeltine LLC. Our website is hazeltinellc.com. My email is info@hazeltinellc.com. Feel free to peruse our content. If you're ready to talk, we can schedule a consultation. I have content on more advanced strategies where we're using infinite banking and velocity banking in tandem. I think the two are very, very, very complementary because when you replace your mortgage with a first lien HELOC, you free up a bunch of liquidity. When you take out your first whole life policy, the drawback is you lose some liquidity, right, when you start out. But the first lien HELOC then more than makes up for all the liquidity you lost in the first few years of your policy, right? And so using those two together can be a way of having your cake and eating it. You take out this great whole life policy and you don't lose any liquidity on net, right?
Awesome. Well, thanks so much, Logan.
Thank you for your time, Jack. Greatly appreciate it.